Welcome to Taking Stock with Lisa Brown. My special guest today is my partner and a member of our CI Brightworth Investment Committee, Mike DeWitt. Now, Mike's been in the financial services business for over 25 years, so he has seen a few ups and downs in the markets, to say the least. And today, there's a lot of headlines about the stock market. And if you're listening to this, you're probably wondering, what's going on? Do I need to run for the hills? I've asked Mike to join me today and to share his perspectives on the stock market, particularly for busy working professionals, which is the audience that we're really gearing our conversation towards today. So welcome, Mike.
Hi, Lisa. Thanks for having me. It's always good to be with you.
Mike, I've got a couple key questions I'd love to get your perspectives on, and thinking about some of the top headlines we're seeing today about stocks and inflation and overall, the message seems to be stocks are down, inflation's up, and the housing market has been going bananas. Does any of this surprise you?
Well, Lisa, I've got a house full of teenagers, so nothing much surprises me these days. I think that the main surprise is how long it took to get to this point and how quickly it's turned, although, that often happens. But even with concerns over the pandemic and the geopolitical issues, these kinds of things, it's really the enormous amount of monetary stimulus that's led to this inflation that kind of, turned on a dime. We've had almost no inflation for years and years. And now we're talking about runaway inflation again, people using those terms. So it was kind of only a matter of time if you look at the money supply and the amount of stimulus that was being applied. And now what's happening is that's leading to the Fed, of course, increasing rates to try and tamp down that inflation. I think they're a little belated with their efforts, but that's beside the point. But I think the biggest, surprise for investors is that both stocks and bonds have been down. The old Hank Williams song, "The interest is up and the stock market's down." He might have not known how unique that is, but most of the time, interest rates are actually going down and bond prices up when the stock market's having a hard time. So I think that's one of the most surprising things. That's causing some indigestion in both the stock and bond markets. As I said, we're now kind of very near that bear market, what people call when the stocks are down 20%. We're just about to that point, and maybe it will get on worse from here, maybe not. But if you take a step back and look, we've been in this extended bull market. Listeners may remember back in March of 2009, I'll never forget, the S&P 500 touched 666 intraday, not a good number. And then if you fast forward through the end of last year, the S&P closed at about 4,700. Now you put that price increase together with dividends, and the stock market did almost 17% a year for that extended period of time. Indeed, in the last 3 years, over 20% a year. So these are well above average long-term returns. And so in some sense, it only makes sense that we would have some give back now. Back to interest rates, though, this is really key to me to what's going on. The real rate, or the Fed funds rate, that's kind of the bottom rate, the risk-free, very safe rate. And all other assets really are priced off of that risk-free rate. They have some premium above it. Obviously, a high quality muni or corporate bond, not a lot of risk above that risk-free rate. Stocks, a lot more risk. So anything with an income stream, right? The current value of it is just the discounted value of all its future cash flows, all the earnings the company is going to earn, all the interest the bond's going to pay. And so what's happening in the market right now is investors are adjusting prices down, as I said, on both stocks and bonds for the fact that those rates are going up. And that's what's causing most of the volatility. Now, you mentioned the housing market. Interestingly, housing has held up pretty well. I think mortgage applications have definitely slowed down, but we have this situation of imbalance between supply and demand. There's simply not enough supply of houses. And so, to the idea that we end this with some spectacular crash in housing, I think that's probably unlikely via the way it ended in '08. But some slowdown is definitely occurring and probably likely to, and that's what the Fed's trying to engineer. So the final piece I'd mention is on the side of real estate, commercial real estate. So that's pretty much holding up pretty well across the board in the different aspects of commercial real estate, and it tends to be a pretty good hedge for inflation. So that's what a lot of investors are looking for, is a hedge against this inflation we're seeing.
Yeah, I think that makes, a lot of sense when you look at the perspectives of, over a decade ago, well, almost 15 years ago, how uncomfortable the stock market was in that '08, early '09 timeframe. But then, things really settled down and got on a good trajectory, and may have turned out better than a lot of people thought. And so I think, that's an important point, that it can feel uncomfortable right now, but you do need to keep looking towards the future and keep your, your eye on the long game for sure. So another headline that I saw the other day that caught my eye was talking about the tech wreck that's going on right now, and whether it's another dot-com bubble that's about to burst. So, Mike, you and I remember the dot-com burst, but some of our listeners may not. Remind us about what happened in the late '90s and the early 2000s with the tech stocks and the dot-coms, versus what's going on today with tech stocks.
Yeah, sure, Lisa. This is really getting to the crux of what most investors are paying attention to. The technology sector is really the largest sector of the U.S. economy, and so a lot of things going on there. And wreck is probably a pretty good word, honestly. I think it was in 3 days last week that over $1 trillion of market cap was destroyed in the tech sector alone. We have the Nasdaq index, which, unlike the S&P that's more broad, the Nasdaq is mostly technology and biotech type companies. It's down, upwards of 25% year to date. So clearly, in what the officials would call a bear market. But under the hood, you look, it's even worse. And over half of those Nasdaq stocks were recently down 50% or more from their highs. So just some tremendous volatility. To pick out a few notable ones that really kind of did well during the lockdowns of COVID, but are now really getting their comeuppance. Netflix is down over 70%, Peloton down over 80%, Metaverse, formerly known as Facebook, down 40%. Maybe they should have kept the Facebook name. I don't know. But, for us old people, as you said, the dot-com bubble, so-called, was, over 20 years ago. It's hard to believe. But what was happening, for those who may not remember, back in the mid 90s, there was this real just sort of love affair with everything technology, as the internet was really coming to fruition. And we were starting to see glimpses of what that would become. Called the dot-com bubble because it was indeed anything with a .com at the end of it, pets.com, anything was really just going through the sky. And you had, valuations that we had really never seen on stocks before. So companies that had no earnings at all, right? And that's not untypical for a new, kind of startup company, but to have no earnings, many of them no revenues, no really even plan for revenues, SPACs, anyone in today's market. Stocks were being valued, if you remember, by what's called clicks and eyeballs. It was like, don't worry about if we're making any money. Just look at how much traffic we're generating to our site. One of the most spectacular, famous ones, at least in the industry, it wasn't a well-known name, but theglobe.com, sounds very, we're going to take over the world, went up over 600% in one day on the IPO of the stock. I mean, this is incredible stuff. And of course, inevitably, this led to just a spectacular crash that took about 2 or 3 years, the NASDAQ index falling in total 78%. I mean, these are Great Depression type numbers. It took the NASDAQ until I believe it was 2015, so some 12, 13 years later, before it got back to the point it was before the crash. The aforementioned theglobe.com, which you've never heard of course, because it doesn't exist anymore, went from $97 to 10 cents and eventually out the door. Even stocks that we consider to be stalwarts of our economy nowadays, Amazon, everyone's heard of that company for sure. It was down 90% during the tech wreck. Or the dot-com bubble, I'm sorry. Cisco, another really, really big popular technology, down 80% at that point. So, here's the important lesson, though, I think, is the dot-com companies and the internet, of course, became everything they were advertised to be, right? And then some. I mean, if you just think of the incredible advances in technology and the iPhones and all of these different things that we have to make our lives more productive and easy and everything else, it transformed business. But the difference is in investing, we have to look at what's a good company, a good idea, a good product versus what's a good investment. And many companies can be good investments if their valuations are, proper and reasonable. And so, similarly today, so Goldman Sachs, they actually have an index of non-profitable technology companies, and there are many of them. That index is down something like 70% almost. So the market has a way of kind of evening things out. And if you think about back to the analogy in the first part about income streams, and the market is discounting all the future cash flows. Well, if you're a high tech company, fast growing but not many earnings, right? Your earnings are way out in the future. Certainly any dividends you might pay are probably way out in the future. And so the longer the time is until I'm going to get my money as an investor, the longer that duration, the more I'm discounting back. So that's a part of why I think interest rates rising are really doing the most damage in the tech sector. It's not a situation where technology is going away or they're no longer good investments. It's just a matter of the valuations, that we're paying here. So, another lesson, I think, if since we're talking about old times, our beloved Atlanta Braves, you remember in 1991, became famous for going from worst to first in the National Baseball League. Now, of course, the end of the story was we went to first, but we didn't actually win the World Series. But we did get a ticker tape parade just in celebration. But the point is, just like the Braves and other sports teams rotating worst to first, stocks often do the same thing. So, it was in the news this week. Saudi Arabia's company Aramco, the big oil conglomerate that went public a time ago, it's now overtaken Apple as the largest stock in the world. I mean, that's a pretty prescient thing. And of course, in the energy industry, which is the one area of the market doing quite well this year, another plug for diversification there. Similarly, back in the pandemic, I think in around the fall of 2020, Zoom, which we are talking on today, and which most people had never heard of by that point, that company was bigger than ExxonMobil. Just incredible. And now, sitting here today, ExxonMobil is over 14 times bigger than Zoom. So just an incredible, difference and increase in the volatility. Mark Twain, again, going back in history, one of my favorite authors, he had the famous quote attributed to him: "History doesn't repeat, but it often rhymes." And so I think that there are a lot of similar things to what's going on today as in the dot-com bubble, but it's not quite the same. And mostly because while valuations had gotten ahead of themselves on a lot of these NASDAQ companies, they're by and large not unprofitable, right? While there are incredibly innovative things going on with AI and biotech and things, there wasn't this sort of complete new Wild West like the internet where we had no idea where revenues and earnings were going to come from. So I do think it's different than it was during the dot-com bubble, but still, if you're really loaded up on those high-flying, companies, it's certainly been painful here lately.
Yeah, another lesson, Mike, I think about for our clients and listeners that are working in corporate America is, make sure you don't have all of your human capital and all of your investment capital tied up in one of these companies, whether it's a tech stock or not. So, if you're working for a company that's one of those high flyers, and you can clearly see your paychecks coming from them, your balance sheet's growing as a result, but then all of a sudden you have a correction, a cooling off, 50-80% reversal in that stock price. You just don't want your whole financial future tied to one company. So I think that's another good lesson for what happened 20 years ago, what happened 100 years ago, and what's happening today.
For sure, yes.
Now, a little bit earlier today, Mike, we were talking about bonds. I often refer to bonds as boring, but bonds are making headlines today. And I say boring because historically bonds are pretty steady Eddie. We don't see the prices change that much compared to stocks on a day-to-day or a month-to-month basis. How are you feeling about bonds these days?
Wow, this is really a great question, Lisa. And again, it gets kind of to the crux of what's going on in the different markets. The question you're asking about bonds is really it's today's version of quote, it's different this time. Investors often use that phrase when the market is going really in a crazy direction and really unique seeming things have happened and they think, wow, that's it for stocks. Well, a lot of people are waking up here in the first few months of 2022 and feeling that way about bonds. As you said, after really decades of being kind of just boring, steady Eddie things, consumers are really paying attention. And it makes sense. In polls, you'll ask consumers, the number one concern that they have is inflation. And that's exactly what is impacting bonds. You said it well, the main reason people own bonds, of course, is to receive income. And people have almost forgotten what that is, right? With the actions of the Fed and in the markets in general over the past few decades, interest rates have just gone down, 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 and savers are really almost receiving nothing in some cases, at least on bank deposits and whatnot. But the number two reason people own bonds is for their stability, right? As we were talking earlier, usually when the stock market is getting hammered, people flock to the safety of government and other bonds. Bond prices go up. But here we've had the situation where they're going down. So I think that's, as you asked before, one of the things that most conservative investors are really, really surprised about, right? They kind of have an eye over there at the stock market. They don't have a lot invested in it, but I've got all these bonds. And I look and lo and behold, the bond market, overall is down something like 10% year to date. This is a huge move. And of course, the thing is, without getting into all the math, interest rates are so low that just a tiny move in rates makes a big difference, right? Most listeners will not pay much attention as the 10-year treasury goes from 2% to 3%. Big deal. Well, in bond world, that's a huge deal. That's a 50% increase in rates. And it's especially painful if you own longer term bonds. And it might be worth a little bit of explanation here because it's kind of confusing to people. As a bond investor, I want higher rates, right? If I'm getting 1 or 2% off my safe bonds, if I can in the future get 3 or 4 or 5%, that's a lot better, right? And that's true, and that will come in time. You just have to be patient because what happens in the interim is the bonds that I currently own that pay 1 or 2%, they have a fixed rate. I'm always going to get that 1 or 2%. Well, lo and behold, the market rates are increasing to that 3, 4, 5%. Well, now I could go out and buy the same bond, same maturity, and all the rest and get 3 or 4 or 5% interest, but mine only earns 1 or 2, right? So it's not as valuable. The price has to go down. Now, it will mature at par if it pays off, and certainly government bonds and high quality bonds, we would expect that to happen. But in the interim, you have these decreases in prices, and that's really painful. But I would say that as far as how we feel about bonds, it's hard to believe, but they do still play an important role. They are a good diversifier in most markets. It's probably unlikely that if the stock market were to continue going down, 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 and it could, if we're on the precipice of a recession or some other calamitous event, stocks could certainly go lower. They can always do that. But if they do, the economy is most likely going to continue to cool down, to accelerate that cooling down, if you will. And if that happens, right, inflation is probably going to go down some because people aren't spending as much money. Companies aren't borrowing as much to expand and all the like. And if that happens, likely bond prices will moderate somewhat. So, the other thing I would say is there are other assets. We mentioned real estate before, but many people in the South own or have exposure to timber or other types of real assets. Farm income has certainly been in the news relative to everything going on in Ukraine and elsewhere. And so, it again, back to your point of diversification, if you have access to other types of investments that can do well or can produce some income, certainly people who own private businesses, that would be the case. Those can be a nice, ballast to the stock market volatility as well as your bonds.
Yeah, great point on diversification. And that really leads into the next question that I know people are really thinking about is what should I be doing with my money today? Should I be running for the hills if stocks and bonds are down, or should I be getting greedy and just buying up everything that's on sale? So I'm confident you've got some thoughts on this, Mike. Would love to hear it.
Well, I guess I should, because this is probably, as you know, the most often asked question we get from investors. In fact, you put it in a little bit more practical terms. It's usually some version of, hey, what's going to happen next?
Right.
What's the future in the markets? And listeners may be disappointed or surprised to know my answer would be, I don't know. Neither does anyone else. That's the thing. It's what's important is you said investors. What should an investor do? Not a speculator or a trader. For long-term investors, the best answer to your question is probably neither. It's probably not time to run for the hills or buy up everything in sight. It's not usually a good idea to change your portfolio strategy in the middle of high volatility, right? So, that's exactly why, as you alluded to earlier, we encourage, for example, people headed towards retirement to ensure that you have a comfortable portfolio that you can live with for the long run. And if a lot of people, as they're approaching retirement or some other big, event where income's going to stop, it's like, I need to get really, really conservative. And right then, when I get to retirement, well, if you were all in stock and you decided you should be half stock and half bond just to make something up, when you get to retirement, if you wait till the day you retire, and that happens to be a bad time in the markets, that can lead to poor decision making. So, everybody's individual situation is different, but generally, you want to get to that portfolio that you can hold on to the long term. And yes, in times like this, even with ugly headlines, it's usually a good time to rebalance and add to what's down. Now, the challenge, of course, is, as I said, stocks and bonds are down. So, but people who are current savers, who are chucking money into the 401k regularly or other types of savings, cash from the sale of a business, et cetera. I mean, there is good news out there. Corporate earnings are still very strong. For the most part, companies have been able to pass along price increases, which means that for now, demand is pretty good for goods and services. Unemployment is exceedingly low, and so that's a good thing, right? There are lots of consumers out there. Those consumers drive most of the economy, and for the most part, their balance sheets, these consumers, all of us, are in really good shape relative to recent history. So all of that, strong, fundamentals will provide some bottom for stock and bond markets, and it's the other thing is, valuations, as we were talking about the tech market, but just valuations on stocks in general had gotten kind of extended with all of this monetary stimulus and the rest. Asset prices in general were up. I'm not going to use the word bubble. Nobody, it's an overused term, and you don't know until hindsight. But in my view, valuations weren't so high that we had what I would call a bubble that has to pop in some, really, really crazy way. So now, of course, with prices down, valuations are more reasonable. And so we would expect the future returns to be better than they would have been, 3 months ago before all this. So, there's always something going on in the headlines, something to get your attention. Certainly when markets have fallen as much as they have, investors are really paying attention. But, if you have faith in, general capitalism, free markets, et cetera, we're going to continue to innovate. We're going to continue to make profits as companies and as industries, and that will lead to returns down the road. So, great question.
Yeah, I think the point you made, Mike, about especially for those who are working, you keep pumping money into your 401k, and just because the headlines seem a little ugly, a little scary, is not a reason to stop saving money for the future. So that's one of the things that people can have control over in terms of their financial future, is what they're saving, what they're putting away. And in many cases, that's more powerful than the investment returns you earn on your portfolio. So that would certainly be something I would echo here as a message to our listeners: is keep saving, keep saving, keep saving.
Oh, I couldn't agree more. It's funny, just as an aside, I think the stock market is the only place where when things go on sale, people don't want to buy more of. And,
Right.
again, you don't need to go crazy and load up on things way out of your comfort zone. But as you point out, if you're doing that regular automatic saving, the same amount of money each 2 weeks or however frequently you get paid, you're now buying more stock than you were buying, 2 weeks ago, 4 weeks ago, et cetera. So yeah, that's a great, great point.
Final question, Mike. I know that you work with a lot of business owners who are looking to one day sell their business, and you talk about the elite exit. So how does what's going on in the markets today impact the planning you do for business owners and achieving their elite exit?
Yeah, thanks for asking about that, Lisa. It's an interesting area where we have a subsidiary called the Business Owner Transition Academy, and what we're doing is really meeting business owners wherever they are in their journey. And we say, hey, start planning your exit the day you open your doors. And nobody really is thinking about that, right? When you're starting a business, you're thinking about all the things you have to do to get some money in the door and your products and services out to the public and whatnot. But the concept is to start thinking about your exit strategy way before you're ready to exit. And so it's really best when you have, years to get ready for that. And if that's the case, I would say, and answer your question, what's going on in the markets today is not necessarily impacting their long-term plan all that much. But having said that, whenever we're working with business owners, the first thing we start with is both a personal and business assessment. So your listeners will know the personal side in terms of personal financial planning and retirement readiness and all of the things that go along with that. On the business assessment side, one of the first things we do is get a baseline value for the business, right? It's incredible, but something like 80% of small business owners have no idea what their business is worth. And in our experience, we found that most of them value their own business at nearly twice what the market will actually pay. And there's a lot of internal reasons for that relating to what the business is worth to me personally as I own it and take cash flow versus what a buyer would pay for it. But the point is, we have an internal valuation tool harnesses big data to get numbers on millions of transactions in real time. And so even as valuations change, we can give the business owner a fairly good assessment of what their value is probably is. And that's important for future planning as they're getting ready on the personal side. So for example, I'm working with one now. They're probably 18 to 24 months out. And when you think about, we're talking about the markets, when interest rates go up, right, the buyer of the business, they have to demand a higher ROI, return on investment, right? Because the money, especially if I'm borrowing money, it's costing me more. So in order to get the rate of return I need to have for the level of risk and I'm taking, I need that higher rate of return. Well, what does that mean? It means I'm going to pay a lower multiple on the business that I'm buying, right? And so what you want to do as a seller is make sure you're the most attractive option in the market for that buyer. So you mentioned the concept elite exit. We define that as maximizing value, exiting on your own terms, and without regret. So in order to maximize value in a market like this, what we want to do is work on what we call value drivers. So as you well put, there are many things we can't control, right? What's happening in the markets, the interest rates, et cetera. But what I can do as a business owner is focus on those value drivers, increasing my cash flow, having a documented growth plan, getting what's in my head as the owner down on paper for future buyers to be able to realize that potential. Having access to capital, in a market where rates are rising, if I'm going to have future lending needs, it's good to maybe have a line of credit that's established now. Clean financial statements, all those kinds of things. So one other example I'll give you really quickly is on an imminent sale. So someone is selling sort of right now, in this case to a third party, so an outside buyer, not a family transition or internal transition. So what we'll do is involve M&A people, mergers and acquisition specialists, who can go out and solicit multiple bidders. So even though valuations may have come down or the cash flow has slowed for certain industries, those multiple bidders can create a process where prices, see a little firming. And strategic buyers may not be as concerned with that current multiple if it's a competitive type process. So the last thing that we do, back to kind of where our world focuses, is on what we call taking from the entrepreneur to the investor, right? It's some of the concepts we talk about in the retiring well area, having a clear vision for what life looks like after that exit. And so even for these business owners, it can be a great time, to put liquidity to work in some of these public markets after they've, had their exit, to recreate that cash flow stream they were getting off the business.
Yeah, exactly. That transition from your business or your paycheck to the portfolio is a huge, not only financial transition in your life, but a personal and emotional. So like you said, having a plan, I mean, that works well for so many clients in so many areas of their financial life.
Absolutely.
Well, I'd like to thank you, Mike, for joining me today and sharing your perspectives on the stock market, the bond market, inflation, and all those headlines we're seeing. For our listeners who would like to get in touch with Mike DeWitt, he can be reached at 404-760-9000. Thanks again for joining us. Be well and stay tuned for an important disclaimer. The statements and opinions expressed herein are subject to change without notice based on market and other conditions. The information provided is for informational purposes only and should not be construed as investment or legal opinion. Please consult a tax or financial advisor with questions about your specific situation. Investors may not invest directly in an unmanaged index, and past performance is not a guarantee of future returns.